Welcome back to the deep dive. Today, we're getting into the minds of institutional investors, but maybe not in the way you'd expect. We're not just looking at what they bought, we're looking at what they sold. Because, sometimes what a big fund decides to trim from its portfolio can tell you a whole lot more about their strategy right now than, say, their huge long-term holdings. Our mission today is to really try and uncover the signal behind one specific major portfolio adjustment, a strategic reduction.
Exactly. It's like when these large institutions file their mandatory reports, their 13Fs, we get this little peek behind the curtain. And when they decide to pull money out of something, especially a company that on the surface seems to be doing really well operationally, well, that's a critical signal. It tells you something about their risk appetite, maybe their view on valuation. We need to figure out, is this a vote of no confidence in the company, or is it more about managing risk in the broader market?
Okay, let's get straight to the main event here. We're talking about Granite Investment Partners. They're a California-based manager. And in their latest quarterly 13F filing, that's the report showing what assets they hold, they revealed a pretty significant move involving a tech company called Agilysys, ticker is AGYS. So they cut their position by 89,611 shares just in the third quarter. Now, that works out to an estimated $11.9 million net value change. That kind of number, it definitely makes you stop and think.
It absolutely does. I mean, that 13F filing, it's our window into how they're thinking. And a sale that size, nearly $12 million, well, it's not accidental. It signals a very conscious strategic choice. So our job now is to kind of dissect that. Why did they do it? We need to look at the mechanics, the financials, sure, but also who is Agilysys? What's their business in hospitality tech? And what's the bigger picture, the market sentiment? That's how we'll understand Granite's move.
All right, let's unpack those financial mechanics first, because the size of the reduction, it tells us something about the commitment Granite was, well, willing to give up.
Right. So selling those, what was it, 89,611 shares, that immediately cut their overall exposure to Agilysys. And here's a key point. Before the sale, AGYS made up about 1.5% of Granite's total reportable assets under management to their AUM. After the sale, that stake dropped down to just 1.0% of AUM.
Okay, so 1.5 down to 1.0. That might sound small, but in portfolio terms, that's actually a pretty big signal about risk management, isn't it? They're deliberately lowering how much weight that position carries. So after everything settled, end of September, Granite was left holding 170,335 shares. Still significant, valued at $17.9 million then.
And here's the context that really makes the decision clear. Trimming it down like that, it immediately pushed Agilysys outside of Granite's top 5 holdings. So you can see a kind of prioritization happening within the firm.
Yeah, and if you look at where their really big bets are, you see where the confidence lies. It's all in those huge established tech names. Blue chips. Their top 5 holdings, I mean, they're a massive chunk of their AUM. You've got Microsoft way up top at $74.96 million. That's like 4.3% of their AUM. Then Google, Apple, NVIDIA, Amazon, all big multi-million-dollar positions.
Exactly. Those 5 alone are, what, over 15% of their reported assets?
Easily. Microsoft, Google, Apple, NVIDIA, Amazon. They're clearly comfortable with big tech.
And this is, well, it's almost a textbook example of portfolio streamlining. They're selling Agilysys, which is more of a mid-cap specialized player, and it signals they're deliberately reducing exposure. Maybe reducing exposure to names that might carry a bit more volatility, or maybe less liquidity compared to the giants. They seem to be prioritizing the stability, the known quantity of these huge tech leaders over, let's say, the incremental risk of a smaller, even if it's growing company. It feels like a vote for stability and scale, which, is pretty typical when big managers get a little nervous about market volatility creeping up.
Okay, that clarifies the financial logic, but it really sets up this huge operational paradox we have to talk about. Because before we just write this off as Granite losing faith in Agilysys, let's actually look at the company they trimmed. Who is Agilysys? Why does their business look so strong on paper, even as Granite is stepping back a bit?
Agilysys is, well, they're quite interesting because they are so specialized. They're a tech company, but they focus only on the hospitality industry. We're talking hotels, resorts, casinos, cruise ships, big restaurant chains, all over the world. They don't really play in the general enterprise software space. They stick to their niche.
Right, and they provide what the industry calls mission-critical systems. That's the tech that absolutely has to work for a big hotel or resort to function, right? Things like property management systems, PMS, that handle all the bookings, the check-ins, the billing, and also point-of-sale tech, for restaurants, bars, gift shops on site, if Agilysys' systems go down.
The hotel basically stops.
Yeah.
It's that fundamental. And their business model reflects that importance. They make money from software licenses, sure, but increasingly from subscriptions Those recurring payments everyone loves, plus technical support and services.
Sure.
If you look at their numbers over the last 12 months, their trailing 12 months, TTM, revenue is almost $300 million. And they're profitable, about $24.4 million in net income. Pretty solid.
Okay, but here's where the tension really ramps up. In their latest results, Agilysys reported its, get this, 15th consecutive quarter of record revenue.
15 straight quarters.
Yeah, think about that streak. 15 times in a row, they've set a new high for their own operational performance. Their latest sales were up 16% compared to the year before. And the really critical part, their subscription revenue. That climbed a massive 33%.
Huge growth in subscription.
Well,
That's
yeah.
the golden metric these
Yeah.
days. Sticky, recurring revenue. And yet, despite that really explosive operational success story, the stock's performance has been, well, underwhelming. Is that fair to say?
Underwhelming is putting it mildly. As of Tuesday's close, when we looked, the stock was only up about 4.2% over the past year.
Only 4.2%.
Yeah. And that 4.2% gain, it's lagging the wider market by a huge margin. The S&P 500 was up, 14% over that same time? So let that sink in. You've got a company delivering 15 record quarters, 33% growth in recurring revenue, but its stock is way behind the index. That paradox, that has to be at the heart of Granite's decision, right?
Precisely. That's where we need to connect the dots. We need to move beyond just saying, oh, they were being cautious. Why would you divest, even partially, from a company reporting that kind of consistent growth? The answer almost always comes back to valuation. It comes down to the market's calculation, or maybe Granite's calculation, of whether all that good news, all that growth is already baked into the current stock price.
Ah, the baked-in argument. So the thinking is, Granite wasn't necessarily doubting the business itself. They were doubting the stock's ability to go much higher from here, given its current price, maybe especially in a choppy market. But couldn't that be a mistake? I mean, if that 33% subscription growth keeps going, isn't there a risk Granite is just selling low here just to de-risk their portfolio?
Well, that's the fundamental tension every single investor faces, right? Granite's move likely reflects a view that Agilysys, even with its great fundamentals, was maybe trading at a valuation multiple, a price that didn't leave much room for error. You know, when you compare it to a Microsoft or an Amazon, sometimes those tech giants, even though they're huge, might look relatively cheaper on certain metrics, like enterprise value to revenue compared to some niche high-growth players. So Granite could be making what they see as a rational trade, trim exposure to an asset that needs to keep executing perfectly just to justify its current price, and shift that capital into the giants that offer more stability, much deeper liquidity, and maybe more predictable risk profile overall.
So Agilysys was kind of maybe the highest beta name, the most market-sensitive stock in that part of their portfolio, the one they could trim without really changing their core investment thesis. It's like portfolio housekeeping almost, reducing exposure to stocks that might get hit harder in a downturn because their future success is already so heavily priced in by the market.
That seems like a very plausible interpretation. That's the key implication here. While the fundamentals, they still look stellar, that recurring revenue model, the strong product adoption, those are powerful long-term advantages. But the stock's volatility, the fact that it hasn't kept pace despite the good news, it underlines something important for institutional investors. A stock's future isn't just about growth headlines. It's about execution, yes, consistency, yes, but also about the market's appetite for risk at that particular moment. And when that risk appetite drops, often the first things that get trimmed are those growth stocks that already look expensive.
Okay, I think that really helps crystallize the main takeaway for you, our listener. Even companies with really robust internal performance. I mean, 15 consecutive record revenue quarters, that's amazing. Sometimes that doesn't immediately translate into stock market wins. And that's especially true if the valuation is already seen as kind of rich and the big institutional players are leaning towards safety, liquidity, low volatility. Granted, it seems, simply prioritized risk management and stability over making a further bet on Agilysys stock quickly re-rating higher.
Yeah, it's a classic trade-off, isn't it? They likely took some profits from what's probably a solid investment for them over time, but maybe it had sort of run its course within their high-conviction, riskier bucket, so they dial back the stake to that smaller 1.0% weight, and probably shore up their positions in those safer mega-cap names we talked about. Makes sense from a portfolio management perspective.
Right. So let's just quickly recap the journey we took here. We started with this pretty sizable $11.9 million institutional sell-off by Granite Investment Partners in Agilysys. And we've kind of unpacked how this wasn't necessarily a thumbs down on the business itself. It looks more like a strategic move, prioritizing risk management, stability, liquidity, especially when the market feels a bit uncertain.
Exactly. And at the same time, we confirmed that Agilysys, the actual company, its underlying business, seems strong, consistent, especially within its specialized hospitality tech niche. Those mission-critical systems they provide, and maybe most importantly, that impressive 33% growth in subscription services, that offers a really powerful structural advantage for them.
Which leaves us with maybe one final provocative thought for you to chew on.
Hmm.
Given that Agilysys specializes in these truly mission-critical systems for the global hospitality sector, maybe the real question isn't just about whether its past growth is already priced into the stock. The bigger challenge or opportunity might be whether that accelerating shift towards subscription services, that huge 33% number, can actually insulate the company from broader economic bumps down the road, maybe better than its recent stock performance would suggest.
That's a great point. It forces you to look beyond this, momentary dip potentially caused by institutional trimming. Does the underlying strength of that recurring revenue model, does it ultimately win out over maybe skeptical or cautious market sentiment right now? Will that operational excellence inevitably force the market to reevaluate the stock at some point? That potential separation between the business's fundamental strength and the market's current mood. That's really the crucial question for Agilysys going forward, isn't it?
A perfect place to leave that question hanging for you to think about. Thanks for diving deep with us today. We'll catch you on the next one.